All right. Hi, everyone. I'm Lauren Moon. I'm here with Jonathan Ting. Um, this is my first Instagram live, so bear with me. But we thought this time around it might be interesting for clients and whoever's interested to watch kind of Jonathan and I talk about our thoughts on some things that are going on. We'll get a little bit more into kind of portfolio management and some planning topics today. But feel free to send over questions as we're talking, and one of us will take them. So, Jonathan, go ahead.
Yeah, I guess I'll start. Lauren and I were talking about the best way to do today's video, and last week I talked about how we're looking at the markets, how we think about it. So today, like she said, we'll focus a little bit more about how we think about it from a planning perspective, right? Because planning for your financials is not necessarily buying the best stocks or something. It's about building a plan, looking for the long term. So I prepared a couple questions for Lauren that I thought I'd like to know. If I think about my future financials, and I think our clients would like to know too. Um, one of the first questions I want to ask Lauren is that you work with a lot of clients that happen to have a lot of concentrated stock in their portfolios, whether that be from RSUs because of where they work or the company went IPO, and even outside of those, a lot of people have their own little trading account on the side, where it might be an 80% Apple or something. Um, how do you, given what's going on and everything like that, how are you thinking about, or how are you advising your clients who have really concentrated stock positions and what they should be doing? Because you know, I imagine if you have a really highly concentrated stock position, it's in like a technology company, probably
Mhm.
software, most likely, and either that's sort of stayed where it is, or it's come down like 30%, and you're asking yourself, okay, is it going to come down more, or is it going to stay there? And you don't really know what to do. What are how do you think about that?
Sure. So it's of course different by client and the specific situation. If it's a bunch of Apple in your personal day trading account, or if it's a whole bunch of Google and you work for Google and you can't access it all, we manage it and we advise differently based on those kinds of specifics. But generally, one of the first things we do with our clients is to evaluate those concentrated positions and develop a plan to reducing them um, if possible. So in terms of kind of the current situation we're in, it's hopefully not taking us by surprise that we have this exposure. We either have a plan to reduce it and we recommend continuing reducing it, or in the case of maybe unvested RSUs or options that may not be exercisable yet, we will have built a portfolio on the Mirador side to balance out that risk on the company side. So I'm actually not recommending that clients make many changes to these plans. I've gotten a lot of calls like, oh, I've been selling my RSUs as they best. Do I really want to keep doing that right now? And my answer is yes, because it's not, it's still the same thought process in terms of if you had $5,000, would you turn around and go buy your employer stock in it today?
Mhm.
And we always advise people to be careful about how much they have with their employer or any concentrated position, because their job security is in it, their bonus is in it. So in the times like now, it's kind of proving kind of what we talk about and why we give this advice. If somebody has a lot of employer stock that they've been building through their employer stock purchase plan or RSUs they've never sold, now they their job may be in jeopardy, their bonus will likely be less next year. There's just all sorts of variables tied to that stock position, that the answer is, even if the timing in the market isn't perfect now, we still advise reducing that risk in that single position and diversifying it in more of a balanced portfolio. I'm
That,
not
that
sure
makes
I
sense.
answered all the points there, but we balance it out both in terms of, if you have a ton of equity exposure that you can't reduce, we'll make your portfolio more conservative. Um, If you can reduce it, we recommend staying on that plan and buying into one of our more diversified strategies, but not halting any kind of plan because of the market environment we're in.
That makes sense. Um, well, I like what you said about like if you had $5,000 today, would you be buying your company's stock? And that reminds me of what Don has said before, which is like when he's thinking about MLS and he's looking at the holdings, he's thinking, okay, if I'm not buying today, I'm selling.
Mm-hmm.
I guess that's sort of the mindset you have to have when it comes to that. What about the clients that maybe they don't have a concentrated position, but they have maybe a portfolio that they built in like 2009 after the crash,
Mm-hmm.
and they've just held it till now. So they have a lot of legacy positions, um, where they have a lot of embedded gains, and maybe they're sort of attached to some of the names in
Mm-hmm.
there, or they have a lot of cash on the sidelines that they've been afraid to deploy. How should they be thinking about building their?
Yeah, it's a great question. And we've had a lot of kind of existing clients asking that question as they've come over with legacy positions. And for example, S&P 500 ETF that they had a big gain in, it's fine. They don't want to sell out of it. I've been bringing it up in the last couple of weeks, like, hey, let's sell these and reinvest it in the strategy you're in a more specific subset. And we've heard you talk about it, and Don talks about it a lot. It matters what you own. But what's been interesting is that we keep having this question come up from clients saying, well, but I don't want to sell low. Like I shouldn't sell low. I shouldn't sell low. And which is great because like people are educated that they shouldn't sell low. That's the perfect kind of clients we want. But what I've been explaining a lot is that we're not selling low. We're just changing what we own. So big picture, we believe the markets will come back as a whole. We don't necessarily believe that every individual company will come back. So the S&P 500 has a weighting of, it's about 5% to energy right now, for example. So it's not a huge weighting, but it's 5% of the S&P 500 is in energy. In the Mirador Longview strategy, it's less than 0.5%. So for example, I think, we may all believe that Chevron and Exxon will recover 10 years from now, for example. But if we think other companies will recover 2 years from now, wouldn't we rather be in those companies that will have a faster recovery than wait for oil to recover over a longer term? So I'm trying to, I've been having a lot of conversations around not necessarily pulling out of equities entirely, but using this pullback as an opportunity to switch out of either more passive or kind of legacy mutual fund positions, or just any position people have had for a long time and not wanting to sell, to say we're entering into a new kind of era, and it's a good time to make sure that what you are holding is going to make sense in that new era.
Yeah, that makes sense. One of the things, I don't know, one of the things that came to mind to me was that uh, I hear people like they have this position that is losing money, or either it's making money, and they're like sort of tied to it. So it's like, oh well, I'm stuck in it. So they feel like they have to make it back with that exact stock, or or they
Mm-hmm.
have to make money with this certain stock just because they've held it for a while. And I was thinking, that's not true. The way the good thing about being a minority investor, in public securities, is that you don't have to buy something and you're not forced to hold it for 10 years. You can
Mm-hmm.
sell it whenever you want. So I always tell people, I tell them to think about each day as a new day. Don't
Mm-hmm.
worry about what happened yesterday or a year from now or where you started from, because where you are today is all that matters, and you're looking forward, not backwards.
Definitely.
Okay, that's interesting. I have a last question, which is given what's been going on this past 2 weeks, how should people be thinking about their financial plans in general? Should they be changing their financial plans? They be changing the way they think about it? Or should they just, because I've read some articles online where it just says, stay the course. Don't worry, don't touch anything. Things will come back. This is, these happen, these market cycles happen, just don't touch anything. Whereas, there are a lot of people saying, oh, you need to get out of this, you need to get out of that. I know like you said, in MLS, we don't actively hold, airlines or energy that much and stuff. But as for the plan in general, sorry, kind of got on a tangent. As for the plan in general, how should people be thinking
Um, my answer again is it depends on the client and the situation you're in. So I'll give you some examples. So I have some clients that are in retirement. They are, as we refer to it, well past the line. They're going to be okay. They'll be able to ride it out. So we make sure we have the planning there has been to make sure that there is cash on hand or enough lower risk assets on hand so that we have the ability to invest in equities at lower prices, because the main objective of these accounts is kind of maximizing growth. And that's a similar situation for kind of some people at mid-stage in their career. When they have a really long time horizon, we first make sure they have enough cash. And in the past, maybe it's been, a month or two of cash, and now we're really extending it to 3 or 4 months of cash to weather whatever happens. But really making sure there's funds set aside to deploy to take advantage of the downturn. So then there's, of course, the group who's approaching retirement, and I think that takes a different stance. We've had some new folks come on whose portfolios have been positioned, I think, maybe too aggressively for their situation. And so that is a case where we've been recommending, this may not be the perfect time to sell, but we do want to make sure you have cash or low risk assets to manage your life over the next couple of years, because we don't know what the future is going to hold, but there's no guarantee you're going to get a full bounce back in the next 6 months if you ride it out. So I think planning comes down to a lot of risk management. It comes back to what each individual's kind of situation and goals are and timeline is. And so I think now is a really important time to be coming back to those plans, reevaluating if you're still in that situation and what adjustments need to be made.
Makes sense. Thank you so much. That's the questions I had prepared for you.
All right. Well, I got a couple back for you, Jonathan.
So, oh God.
Okay. We had one question come in over Instagram asking what the stimulus package is going to do to asset prices. Right.
Okay. I saw that question as well, so I'm prepared to answer that. I'll try to keep it short. And that's a really complex question to answer. There's a really simple way to answer that, but it just raises more questions. So I'm going to try to do the best I can. Let me first start off with what the purpose of monetary policy is to begin with. Right? What's the purpose of the Federal Reserve? Is two things: is maximum unemployment and price stabilization, which is making sure that inflation doesn't run away, and that's necessary because we live in a fiat money system, right, where money is not based off gold; it's based off of supply and demand. So those are the two things. So when growth is good, we would tend to see the Fed in a contractionary state where they're reducing their balance sheet and they're pulling cash out of the system. What pulling cash out of the system does, I've heard what was his name? From Morgan Creek. What's the guy's name? Mark Yusko. We heard Mark Yusko say one time an example that liquidity is like oxygen in the room, right? He said when there's enough oxygen in the room, you're focused on what's going on and whatnot. But when oxygen leaves, nothing else matters, and you're just gasping for that oxygen, right? Which is the same with cash. So when economy is doing well, they pull back on the cash to sort of pull back on some of the oxygen, to let people not get so carried away with prices, and prices don't inflate too much and growth doesn't get out of hand, it stabilizes. Well, the flip side of that is true too, which is when we go through times of crises like this, to try to stimulate growth and try to get people out there buying again, the Federal Reserve lowering interest rates, or whether that's increasing their balance sheet by buying assets that are out there in the market. Okay. So to answer the question bluntly, what is the effect of stimulus pumped into the system on asset prices long term? It will make asset prices go up simply because there's more cash in the system. Okay, so if you think about it, if I have a pie of 10 slices and each slice is $1, well, if I just doubled everybody's money, now each slice can be $2, right? Because proportionally, still the same number of slices, and proportionally, it's worth the same to you. So in a time of crisis, this is really great. We saw the Bank of Japan do this starting in the 2000s when their stock market came to a crash. They started buying equities and corporate bonds outright, and that's what they've been doing. So, so one interesting note is, I mean, we look at a company like Uniqlo in the mall.
Mm-hmm.
Uniqlo is 20% owned by the Bank of Japan. Okay, and they continue to buy. So our Federal Reserve has just started doing something unprecedented in U.S. history, which is they've started buying corporate bonds themselves. So soon they're going to be owners of company debt. And will they start buying equities? Who knows, right? It's a slippery slope. But in a time of crisis, when people are selling, what this does is it adds an incremental buyer to the market to sort of backstop when prices go down, right? Because now the Fed is buying assets while you're selling. So in the short term, this is really good. It can stop things from coming down. It provides more liquidity to people in the market through lower interest rates. The small business loan is forgivable, so it's like free money. So people just have more cash to go around, and it'll make itself into asset prices, which will push them up. The only problem is when you try to unwind this. Okay, so it's like
Sorry, I missed that. The only problem is what? I can't hear
when you
you.
try to unwind this stuff. So the Fed is buying all these things, but at some point, if it needs to sell it, that could be a problem because you're adding an incremental seller to the market. And one way I think about this, my dog is laying right next to me. I used to only feed him hard food, okay, and he ate it fine. He didn't know any difference, okay? But the second I started feeding him wet food, oh my God, he won't touch dry food anymore, right? So that's the same with the market, which is when you give somebody something, it's really hard to start taking it back. So so what happens is for in the near term, this will act as a backstop for prices to stop going down. It will provide more liquidity to the market for asset prices to go up. But in the long term, what happens is it's going to be very difficult for the Fed to unwind this. If you look at what happened in 2008 when they increased their balance sheet, even until now, they haven't unwound it yet.
Yeah.
They've been unable to. And now all we've done is they've started buying even more. So this is really unprecedented. It's boggling the minds of many economists and many money market, money managers of what will actually happen long term. Okay, and there's a couple possibilities. One is if you look at the Bank of Japan, it doesn't help. If the world continues to be in a contractionary environment with deflation, it doesn't help. The Japanese stock index hasn't recovered in 10 years. As people are still marginal sellers, but the Fed being the only marginal buyer. The second risk is, it can cause currency devaluation because as you're injecting this liquidity into the market, well, like I said, everybody has more of your dollars, so it's worth less. The only flip side of that for us is that we are the reserve currency of the world, which might make a difference, although it's anybody's guess as to how, because it's never happened, right? And one thing this will make is that this will lead to is that our Federal Reserve will be a marginal owner of U.S. corporations. And if this continues going, like Japan, who owns 20% of Uniqlo already, we might end up with state-owned enterprises like Japan, like China. If this keeps going. So it's a slippery slope we're going down with liquidity being pumped in. It will be good for asset prices, but you also have to look at the fundamentals of what's going on.
Right.
So, yeah, some people just buy because, oh, well, the Fed is doing this. Well, you have to also look at the underlying fundamentals, and if they're deteriorating, well, then you have to figure out a balance. Okay.
Right.
So fundamentals are going down, but on the other side, you have a buyer who's willing to buy at any cost. So is that going to make prices go up? Is it going to make prices go down? It really is hard to say, but it is hard to say. I'll leave it at that.
That's great.
Yeah.
All right. 2 more questions. I'll take one of them.
Okay.
Someone asked, should I stop making contributions to my 401k right now? My answer is no, assuming that you have enough cash for kind of your emergency needs. The great thing about regular contributions to your 401k is that you're just adding to your portfolio over time. It's like long-term dollar cost averaging. If the market's up today, you're adding in. If it's down next week, you're adding in. So it's just a great way to keep building that retirement fund. And this is definitely not the time to stop doing it, in my opinion.
Yeah,
so
most 401ks match too, right? They
what?
match.
Yeah,
Most
especially if you
401ks,
get a match, it's free money.
yeah, it's free money. So I mean, if I think about it math-wise, like if you have $100 that you put into your 401k and you get matched $100, well now you have 200, and the stock market could come down an entire 50% before you're back to even. You know,
Right.
so it's free money. Take it.
All right, last one I'm gonna send to you, Jonathan, which is we've had 2 updates. Is everything fine now?
That's a good question. That's the question everybody's trying to figure out. You know, I don't think you should look at 2 days as a trend. I don't even think should look at a week as a trend. What we are doing when we're looking at where asset prices might move over the next 6 months is not looking at the movement of the price itself. Okay, because the movement of the price itself is simply a reflection of how many people are in the market today, either buying or selling, right? So we saw yesterday where the S&P 500 went up 7%. That doesn't mean we're on a rebound. That only means that yesterday there were more buyers in the market than there were sellers for whatever reason. And how fickle price moves is you can see it today. Yesterday, the only headline that people could find, even find remotely, to bump prices was that the number of deaths in New York and the number of deaths in Italy were coming down. Mm-hmm. Okay, New York came down for the first day, so it said this might be a plateau. Equity prices are rallying. Well, today, the first headline was that New York has the worst day, the highest number of deaths ever.
Right.
And the S&P 500 is still up 3%. Yeah. Okay. Which shows that right now we're really moving off of sentiment, what people feel. And right now it's really 50-50 as to what people feel. What we want to try to focus on when we invest our clients' capital is focus on the fundamentals, because eventually prices will follow with fundamentals. And, you know, I still think right now is sort of a wait and see period. Although the S&P went up a lot yesterday, and it might go up a lot tomorrow too. The good thing about the stock market is it never closes. It runs every day. And you don't have to make money every single day. You don't have to try to make as much money as you can every single day. Mm-hmm. Sometimes it's best to just wait it out and see. I got an example. I'm a poker player, and for those of you who have played poker, you'll know where you get a hand like 3-7, 3-7 offsuit, and you're just like, okay, this is garbage. Let me throw it away. But then the cards come, and you're like, man, I would have hit it straight. Right? Oh, if I had just played, I would have hit it straight. Yeah. You know, and hindsight is always 20/20. Oh, I should have done that. I should have done that. I would have done this. Oh, I threw away all that money. But you have to focus on that, what it is at the time and the risk you're taking on at the time. You know, any poker player who plays 3-7 every time is going to lose money, guaranteed. Yeah. You know, so there are certain situations in the market which is the same, whereas, you know, the conviction is not strong either way. Sentiment is sort of in question. Fundamentals are up in the air. We're not sure. So it's a wait and see period. If there is money to be made during this period, it might not be worth the risk that you're going to take, which is my perspective.
Great. Thank you. All right. Well, thanks everyone who joined. Everyone who's watching this later, feel free to follow up with any questions. Some of us will be back in some shape or form on Friday, same time, same place.
Stay safe.
Bye, guys.